Hi guys, and welcome to another episode of What's on Your Mind. I'm Chris Quill, and today I'm joined by ITPM senior trading mentors Anthony, Iser, and Ben Berggreen. Guys, always fantastic to have you on the show, and look forward to hearing what you have to say today, of course. Seems to me like there's a little bit of a lull in the markets at the moment. Volatility slightly subdued. I think the VIX is trading around 16, 17. Equity volumes are a little bit lighter than they have been in the recent past. Whether that's to do with being in between earnings seasons or whatever, I'm not sure. But I do imagine there is a little bit of concern on the macro side with inflation expectations and also some tapering around the stimulus measures that we've basically grown used to at this point. So it'd be interesting if you guys touched on any of that at any point. But anyway, it's not about my thoughts, it's about your thoughts on this show. So let's get to it. And Ben, what have you got for us today?
Yeah, so I'm looking at a couple of things actually. Incidentally, they're both long ideas today. The market has been it's been pretty challenging actually to find good trading ideas over the past couple of months because at least the US market, most of the NASDAQ and also the small cap Russell 2000, that's just kind of flatlined, right? So in a flat market, it's pretty hard to be long options premium. But anyway, there are some diamonds in the rough, and I found a couple that I'm going to discuss. The first one is Sirius XM, ticker is Siri. And for those of you who don't know, Sirius XM, they provide satellite radio services on a subscription fee basis, and it's really the leading audio entertainment company in the US. It's geared primarily towards cars. They also have a mobile market, but it's really more of an automobile play. They also bought out Pandora in February of 2019, and Pandora is the largest ad-supported audio entertainment service in the US. So between the two of them, they reach over 100 million people each month with audio products. So this play is a little bit bigger than a normal, small cap type of situation. Market cap is 29 billion, so it's more of a mid cap space. But that's okay. It's nice to be a little bit diversified when it comes to market caps. The catalyst for this, I'm going to get into the company specifics, but really the catalyst is more of a macro thing with the latest inflation number topping 5%. We saw the biggest actually price increases in gasoline and used cars and trucks. So used cars and trucks are up 30% on an annualized basis. So there's a huge spike in demand for autos, which leads into auto-related products. Obviously, there's an issue with material availability and the global chip shortage, which silicone kind of ties into it. But consumer searches for used cars are actually double what they were a year ago. And what happened last year with COVID was a lot of rental companies, they sold off a big portion of their fleet to kind of streamline their operations, since also demand for rental cars plummeted. And now they're in a situation where there's been this dramatic rebound in demand, and they don't have enough cars. So they have a situation now where they have to buy a bunch of used cars actually to fill in their fleet. I was planning a trip, a vacation to Hawaii with my wife, and we can't go because we can't find a car to rent. There's just, you want to rent a car, it's like $700 a day. It's insane. Or people rent like U-Hauls. So bottom line is the strong demand for cars, leads into increased potential for car-related, auto-related products. And that's where this certainly fits in. Fundamentally, Sirius in a pretty good position. They have a lot of exclusive programs that are only offered on Sirius Radio, and they're kind of unique because they have a lot of live audio selections with partnered with a lot of celebrities like Drake, Kevin Hart, Howard Stern, and others, and they're increasing that lineup. They also have really strong relationships with auto manufacturers, which helps drive continued subscription growth. So between its own organic growth and acquisitions like the Pandora Media one in 2019, the company is really growing strongly year over year, and it's an entertainment powerhouse now. So the growth, is there. Valuations are, they're not great. They're not super unreasonable. P4 Ps is 27. Price to sales is around 3. This is from the last earnings call on April 28th, talking about self-pay subscribers that reached a record of 31 million. So that's an 83% increase, okay, compared to the same period a year ago. And they also saw the first quarter record low churn rate of 1.6%. So they have very sticky clientele, and also reporting new record high quarterly EBITDA figures. Advertising revenue grew 24%, and that was both from on and off platform opportunities. And they also have a strong growing podcast market. So with all that, gross profits for the company, it was almost $1 billion, okay? And that's with a gross margin of around 61%. And they also kind of mentioned earlier that, they're expanding their lineup, streaming music, but also other content with entertainment and whatnot. So the consensus earnings estimates going forward looks really stable, reflecting solid growth potentials, which is nice to see. But this is really more than anything a revenue story. Okay, so revenue has, and you can see on this chart here that I overlaid with the price. Revenues have been very, very stable over the past 10 years. There was an acceleration in mid 2019, but that was all based on the Pandora purchase. And growth, like a lot of companies, growth slowed past 12 months for obvious reasons. But that was discounted in the price because this stock topped in like mid 2018 and just been going sideways ever since. So I think it's getting set up to crank out of that, considering what's going on with the demand for cars. There are, like in a lot of our situations, there are some risks, and the biggest risk here is really the silicon shortage. It's kind of like that's kind of a two-edged thing. It signals a stronger demand, but with the auto inventories as low as they are, if they're not more cars meeting the demand, they're not going to be more services either, right? So we're going to have to see how that works out. I think it's going to sort itself out. These companies, they're very, they're good at pivoting, and they're good at trying and working themselves out of a tight situation. And I think that's going to sort itself out. So anyway, the stock has been going sideways for a while. It's been hitting up against this 730 kind of resistance area. But, for 3 years, the stock didn't go anywhere. Revenues actually went from 5.5 billion to over 8 billion. So it's really just a matter of time before the prices start catching up here. And also, stock also has a 20% short interest. It kind of plays into the short squeeze kind of craziness we've seen lately. And that could very easily happen in this stock. It did happen actually in January, and the prices went from $6 to $8 in like 2 days. It was like a 33% increase. And because of that, and I'm hoping that's going to happen again, and that's why I'm just long calls here. So I got into the September 6 calls at about 45 cents. That was about a month ago, and I think they're about double by now. But if I was going to get into it now, the next earnings coming out in July, I'm looking at either August or September's. But again, and due to the volatility and the potential for a squeeze, I would just go long, like the September 7s at about 60 cents. The August is trading only 10 cents lower, so you're paying 10 cents more for 1 month extra of time value, which I think is worth it. I think this can easily go to $8 and above, but it's really a play where there's unlimited profit potential. Yeah. So yeah, that kind of summarizes that one.
Yeah, that's interesting to sort of talk through and find a stock that's, not a small cap by any means, like you say, but with plenty of room to move. So quite exciting, that one. Anthony, let's switch over to you now. What have you got?
Thanks, Chris. Yeah, I've got a buy idea. It's quite interesting. It's Raven Industries. The ticker is RAVN. It's about 1.5 billion market cap, 46 times forward earnings. Very small short interest, 1.42%. So unlikely to see a squeeze. But I think it's probably going to go up for other reasons. We won't need a squeeze in this one. If we look at the quants for Raven Industries, revenue for the last 6 or 7 years basically hasn't changed. It was 395 million back in January 2014, and for the most recent year just finished, it was actually slightly lower, 346. So why do I find this company sort of so interesting? We're not looking at the historical quants, obviously. It's there as a reference point, but we're forward looking. And for the quarter that's just finished, the first quarter of this year, revenue was up 30% and EPS was up 143%. So times are changing for Raven, and I'll get to in just a moment to what they do, just highlighting, I guess, further aspects of this quant and some of these forward-looking numbers that I'm finding sort of quite attractive. So sales are going to be up 22% this year, 17% next year, and EPS is going to be up 52% this year and forecast to be up 73% next year. So there's a couple of things that I really like out of that. One is we've got sequentially higher EPS growth. That is always attractive. Upgrades lead to further upgrades and leverage through those earnings. And there's operational leverage here. 17% revenue growth leading to 73% EPS growth. That type of operational leverage is something that I think everyone here at the Institute finds very attractive. So looking at the sector, it's in the plastic and rubber products manufacturing sector. It's a pretty diverse sector, and most of the stocks have a reasonable amount of earnings growth. But again, it was that sequential earnings growth that I found particularly attractive. And then when you look a little bit deeper, you can see why this company is changing and what's going on. So what does Raven Industries do? They've got 3 segments. The first one is applied technologies, and it is smart automated farming. It's about 45% of their sales currently, but I would expect that to grow quite a bit. Margins are going up. They went from 21% to 24% in this last quarter. So things are improving top line and bottom line quite aggressively for that segment. Second segment is composites or engineered films. And this is a range of high-tech materials that get used as liners in oil and gas industries, in agriculture as well, construction and industrial barriers. And they've got a full backlog of orders. They are at 100% capacity for this part of their business. It also represents about 45% of their business based on sales. This was a business that really struggled during COVID. It essentially was sort of almost shut down. So it's recovering very strongly after that low period. Margins are going from 4% to 8%, and will probably return back to about a 20% margin, which was their sort of pre-COVID levels. The third industry segment that they've got is only 10% of their earnings. It's called Aerostar. And Aerostar is stratospheric balloons, weather balloons, radar systems for military and government. So you will have seen those giant weather balloons that go to 60,000 feet right up into the stratosphere, and it's a growing industry, but small at 10% of their sales. So they've got high demand, they've got backlog, they're running at 100% capacity, and they're investing in expansion of this production. All of these things are going to grow and drive sales and earnings. In addition, they made comments in the last quarterly that they are addressing all their cost increases and supply issues that every manufacturing company is facing, and they've put through price increases across the board, which is more than offsetting the cost inputs that they're seeing. Now, in terms of these divisions, as I mentioned, it's the applied technologies one, which I'm sort of most interested in and most excited by. And to put simply, this is a little step beyond smart farming. Smart farming includes all sorts of technology to track soil moisture, work on program seedings, tilling, all aspects of farming. But what they've built and have just sort of released to the market under the brand name OmniPower is a totally autonomous platform, and they're looking to become the industry leader. So we talk about autonomous cars, You see Teslas, crashing. You see people sitting in the back seat. We're a long way off having autonomous cars on the road. It's a very different situation though for farms because they're big, they're slow moving, and they're constrained. They're within farm boundaries, so they're not out on the open roads. We're going to have autonomous farming well before we have autonomous cars on the road. In fact, we've got them now. The farms in the US in particular, but globally, the number of farms is falling dramatically. The size of the farms is rising dramatically. So there's huge economies of scale. And that's why farmers want to invest in this technology. So there'll be fewer trips per vehicle across the farm. That leads to reduced fuel consumption, less soil compaction. We've got more accurate and precise seed, fertilizer, chemical treatments, yield improvement across the board. We've got reduced costs, reduced labour, and we've got the potential here to have these farms operating at 24/7, something that simply can't happen without autonomous systems. So they've already sold 36 OmniDrive systems, which is their driverless ag tech. That's 50% of the current year release. They'll probably sell the rest of them before the next quarter is out, if not sometime early into that third quarter. So after years of flat earnings, this is a true growth story with operational leverage and the top line growing quite well at the same time. So again, just to highlight three major reasons why earnings are going up here. They're selling additional products, they're selling to additional markets, and they've got operational leverage. As an example, in terms of the size of the markets, moving to global markets from simply the US has increased the total addressable market for the engineered film business by about 500%. Second reason is macro-wise, and agriculture is coming out of a nearly decade-long lull. So we've got huge, big tailwinds. There's been underspend on CapEx across the board. So we've got a huge, big tailwind from the sector, as well as within the sector moving to becoming the market leader in autonomous farming. And that is the third point. Technology is driving change for farmers far faster than anyone can really imagine at this point in time. We've got rapid take-up of this new technology, and that's only going to continue. And so this technology is so good. It's really changing farming in a big way. And I would not be surprised that this makes Raven a reasonably attractive takeover target. Now, we would never ever buy a company just because we think it's a takeover target, but it's a potential cherry on the top for this company. But even if it wasn't, be very keen to be involved as it is. Catalyst-wise, we've got further announcements around OmniDrive, so the additional selling of the balance of the 36 units that they've got for now. We've got further expansions, so planned expansions and manufacturing capacity coming through. There'll be additional small acquisitions made in the next couple of quarters as well. And then the result is on the 24th of August. So as a trade, I want to look beyond that result. The options market's a little thinner than I would like, so I've got to look out to November. That's a little longer than we'd probably prefer, but it's still going to work out quite well. So buying 2 of the November 45 calls for $4 each. We're doing a ratio 2 to 1, so we'll sell 1 of the July 45 for $1. That's a net debit of 7. You can do that 1 time, you can do that 1,000 times, depends on what your capital is, but we want to do it in that 2-for-1 ratio. And there's the opportunity of reducing that cost as well as we go through by selling more additional options as time goes by. But ultimately, I want to be very net long at the end of August when this result comes in. So that's Raven Industries, a bit over $42 at the moment. Very, very impressive technology, and just seeing great growth after a decade of flat earnings.
Yeah, that's a really interesting one. Like you say, with the secular kind of movement behind it, and a really interesting theme as well with farming automation. Cool, that sounds great. Let's go back to you again, Ben. What else have you got?
Yeah, so I like Raven. I'm gonna have to have a look at that myself. I'm gonna change gears, talk about a different industry than what I mentioned earlier. So Trex, okay, so Trex company, they manufactures mostly composite products related to residential decking and railing. So this kind of goes into the whole housing boom, outdoors lifestyle type of theme. And there's more to it than that, which I'm going to get to in a sec. It's an $11 billion company. It was half that not too long ago, but the company has grown quite a bit. So they distribute a wide variety of products, okay, for consumers to create more of an outdoor living space, which has been kind of all the hoopla lately. So decking material, but also fencing, lighting products, house sidings, fire pits, and other stuff that kind of goes into that whole environment. And it's sold mostly through wholesale distributors like Home Depot and Lowe's. I like companies that make products or provide services that I know or can see around or use. It's always easier for me because I live in the States. It's just I like to kind of be able to put my finger on it, if you will. So what's so special about this company is the catalyst that I'm looking at. Okay, has to do with the price of lumber. So the price of lumber is up 200% in 12 months. I mean, we saw a big pullback recently, but it's still up 200% in 12 months. But Trex, okay, so their material is made 95% out of recycled material, which is recycled wood, sawdust, plastic items, and so forth. So with lumber prices being crazy expensive, I think there's going to be a shift of more and more people using composite materials for their decking. You can see that on the producer price index saw a huge spike in lumber. Actually, wood products doubled year to date. Okay, so because of those market dynamics, I think the traditional wood deck materials, which is made out of like cedar or other wood, which is now crazy expensive. People are gonna start looking at other options for that, right? So how does Trex materials compare to wood? Well, you can see from their website that compares the cost of for a standard size deck, okay, for wood versus composite. So the initial outlay for composite it was double that of wood, but the maintenance cost for composites is zero. So, and the maintenance cost for a wood deck, depending on where you live, but still, you have to maintain it, fix the wood. So the maintenance cost is a lot higher. So year over year, you save a lot of money. Well, according to their calculations, over $9,000 a year. Now, I think that, considering the sharp increase of price in wood, that is now shifted where the deck material cost itself is getting close to being even, which, it's kind of like less and less of a reason for you to try to buy wood, really. And also the company is doing really well. All right, so they earned $228 million in Q4, and residential products made up the majority of this, and they grew actually 40% just in the quarter. And they have a strong financial position, just top and bottom line. They had that every year, actually, for the past 10 years. Consolidated net sales increased 23%. This is on the last earnings report on May 10th. Diluted earnings was up 17%, and EBITDA increased 20%. And they had, and this is kind of the kicker for me, is that they had $46 million worth of share repurchases, which is always a nice thing to see. And they reaffirmed the full year 2021 EBITDA margin guidance of 35 to 40%. So they're really firing on all cylinders. And also what I like here is the consensus earnings per share revisions trend, which I look at quite a bit, is being cranked higher for every quarter, or every quarter of the next 4 quarters on a 1, 3, and 6 month basis. So there's definitely the market is definitely supporting this stock. Now that is a lot of that, you might argue, has been already priced in because the stock is up quite a bit. It's now at around $100, and the price has doubled, okay, since breaking out of the pre-COVID highs. So it's not cheap, 50 times earnings. And I think because of the way it looks technically and also valuation-wise, I think there's a good chance this stock could kind of grind sideways for a bit between 100 and 110. So that lends itself pretty well to a spread here. So I actually got into the long the October 100 calls at 9, and I shorted the 110 August calls at 320. So my short pays for a third of my longs. Net risk is 580. And then after this thing has gone sideways for a while, and the August hopefully expires worthless, we're going to see if you can get it to crank higher in the early fall. Now, typically I would consider the ratio here, but considering you're going into summer where the markets tend to just kind of grind, and the VIX where it is, this is just a 1-for-1 spread where I'm long as many shares contracts as I'm short. I really have a price target, but like I said, a short-term price target is really 110, and then we'll see what happens after that. So yeah, kind of short and sweet.
Yeah, that's an interesting one because you've obviously kind of framed it over 2 intervals. You've got your long in both intervals, but you see the longer term upside as obviously more, and the way you're structuring that is still going to allow you to profit in the short to medium term as well, which is cool. Cool. All right, let's go back to you, Anthony. We've covered some stocks. Have you got any sort of macro or market thoughts you wanted to put across?
I do, Chris, and it's been a little while. The last couple of sessions I've pretty much just talked stocks. So I've just got a couple of things that I've been thinking about, none of which are startlingly new. We've been talking about these things for a little while, and they've been fluctuating around. So this first chart is something most people will have seen. It's the put-call ratio composite, and it's at a record low for recent years. And it essentially just tells us, the market is net long and feeling confident. And that's sort of reflected in most of the things that we're seeing at the moment. It also says to me that, there's potentially perhaps a little bit of asymmetric risk to the downside if people do wind up being disappointed. And one of the areas that we've talked about a lot that they could be disappointed is potentially inflation. So you brought it up earlier, Chris, and there's lots of initial discussions about tapering. And so really what's going on at the moment, the Fed is talking about tapering. They haven't got to the talking about tapering bit, but the press has started to. So you can see this chart here. News articles have really picked up over the last few months and most of this year, in fact, about tapering. But if we look on historical levels, it's nothing compared to what happens when things really get cranked up. So expect a lot more chatter over the next 3 to 6 months about tapering. But for now, the market has bought into the Fed's narrative that inflation is transitory, and bond markets telling us that, equity markets less so, but still also showing quite resilient behaviour in the face of some underlying inflation numbers coming through that are pretty aggressive. The third chart I've got up here is when it's a survey from Bank of America looking at when people expect the Fed to start actually talking about tapering. So at the moment they're talking about tapering, and Jackson Hole is in August, September FOMC. Most people are looking for that period. It was when they'll really start looking at the data and talking about it and warming the market up to it. Some people thinking a little later, Q4. Some people thinking beyond that. The two smallest segments are for the near term. So that's July FOMC and June FOMC. Now, they're small components. It's like 4% and 7% of those surveyed. So very small. and quite rightly, highly unlikely to have it happen. The Fed has been very clear in what they've talked about. They're not raising rates. Tapering's a long way off. And so far, the market's believing that and running with that narrative. So they've got no incentive to try and mess that up by talking about it earlier. But again, that's where the risk would be. Risk to the downside that we do see some sort of inflation spike, that the numbers are just too large for the Fed to ignore. But to that point, the final chart I've got is a look at forecasts around Fed fund rates and inflation. And you can see from this chart that historically everyone massively overestimates inflation for the last almost 2 decades, through the GFC, through the subsequent period, and then obviously a bit of growth, and then and COVID. We've seen everyone expecting Fed funds rate to be going up, inflation to be going up, and being constantly disappointed. So that may well be the case, and we just grind on through from here. But the risks are probably that there is a spike somewhere. I'm not forecasting that. We're not sort of really in the market of forecasting it. But if we think of how the market's positioned, I suspect the market's not really positioned for that at this point in time. So that's what I'm sort of thinking about on the macro side of things. Have I covered all my bases? Where are the risks? And what sort of decision? We've got FOMC comments and Fed comments coming out this week. We've seen high CPI numbers. It's Wednesday morning in the US now. So anything could happen in these next couple of days, but I suspect it's probably going to be reasonably benign. But we shall wait and see.
Okay, gents. Fantastic to hear from you both this week. Some great analysis as always. It's good to cover a bit of macro as well as the equities that we cover more often. So I'm sure everyone that's watching will appreciate that as I did as well. Now, for you guys watching, this is actually our last What's on Your Mind episode before our summer break. So we're taking a break from the series until around August time. But don't worry, there's plenty of ITPM content to get your teeth stuck into in between. So if you have a look on our website, you can go to the events page and you'll see a number of different events that we've got coming up. I think the first of which is at the end of this month, which is the ITPM half-year conference. I've mentioned that previously on other episodes of What's on Your Mind, but basically it's an online webinar conference where all of the What's on Your Mind mentors that you see on this series and Anton Creel, our managing partner, will be talking to you about various trading topics. And those kind of big conferences that we do are a really sort of good value way to get information from ITPM because you do get access to so many of our mentors and everything, and there's a lot of content that goes out on those. So highly recommend you do sign up to that if you can. I'm sure there's not many tickets left because we're getting close to the actual date of the event itself. So sign up fast if you want to. And then there's another couple of events in sort of singular events coming up in July as well. So by all means, sign up to those. Like I said, you can find out more details about all of them on the website itpm.com, and of course you can sign up to them as well there. But as I said, that's it for this episode, and also from us until August time, when we'll be back with another episode of What's on Your Mind. So we'll see you then.